Now, the S&P 500 is up about 35% since the beginning of March. Valuations are richer. The forward price-to-earnings multiple has gone from about 11 times to about 16 times today. Are investors now paying too much to buy into this rally? Here is Robert Hagstrom. He is the Senior Vice President of Legg Capital Management. He also helps oversee a $2.2 billion portfolio as the manager of the Legg Growth Trust. He is also the best-selling author of The Warren Buffett Way, Investment Strategies of the World's Greatest Investor. He joins us from Philadelphia. Robert Hagstrom, welcome.
Thank you, Pam.
Robert, if you're using all of Warren Buffett's tools, how do you get to the conclusion that the market is not overvalued?
Well, it's interesting how we use price-earnings multiples kind of as a yardstick, and I think most people would agree that the trailing earnings that we're using for those multiples are obviously very depressed. So 15 times earnings on maybe a $60 number might seem to be stretched, but then the question is the $60 number the right number? And we'll have to see going forward. But if you look at free cash flow yield, current free cash flow yield in the stock market, ex financials, we're at 7% free cash flow yield. That's very, very high on a valuation basis, particularly as it relates to the 10-year Treasury that's around 3%.
Well, but what about the debt that is on the company's books? I mean, we've seen, for example, record bond issuance. A lot of people saying that that's pointing to the fact that companies need to raise all this money because they've got a lot of debt coming due.
Well, I think that could be true in certain cases. I'd also point out that the debt markets have been closed, virtually closed for almost 6 months as we've gone through this credit crisis, so to speak. So there was some pent-up demand to issue debt. But if you look in the technology space, though, which is an area we're very, very bullish on, you'll find companies that have zero debt and basically have tons of cash on their balance sheet. And interestingly, Pam, these tech stocks are not trading at 7% free cash flow yields. They're trading at 9, 10, 11% free cash flow yields higher than even what the market yield is right now.
So are you suggesting that if anyone is on the sidelines that they ought to get into this rally? I mean, if someone sold their stock either at the end of last year or they couldn't stomach it and they got out in January or indeed in February and been sitting on the sidelines with cash, is it too late to get into this rally?
No, I don't think it's too late. I don't think I'd throw 100% of it into the market on any one day. But I think if you had a beachhead now, or you started a beachhead, and then incrementally made investments over the coming months, quarters, so to speak, and try to get your best average price over time, I think that's a very smart strategy.
Now, you talked about free cash flow. What about profit margins? Are you seeing those expand?
Well, not really. I mean, the margins have been, though, relatively stable, and we're pretty impressed. And one of that reasons, obviously, is deflation. We haven't seen a lot of price increases that on the user side would have caused margins to be squeezed. But then here again, we haven't been able to see price increases. But the reason why I like technology so much is that this is an industry, as you well know, Pim, that navigates lower prices as a way of life. So if we're indeed in a long-term deflationary cycle, technology has lived this their entire life. They know how to navigate this world.
Well, let me just press you a little bit on technology. I mean, if you've been waiting for the NASDAQ to come back to those 2000 levels, it's not happened. What do you say to people that got in then and then we're still waiting? We're at 1,700. Yeah,
well, undoubtedly 5,000 and 60, 70, 80, 90 times multiples was a little rich in 2000, no doubt about it. But, it's interesting when I was thinking earlier today, if you compare and contrast the balance sheets and the economic viability of the tech sector today in the NASDAQ, relative to where it is in 2000, it's night and day. In 2000, there was too much debt. Earnings multiples were way too high. It was living on borrowed time, no doubt about it. If you look at it today, it's almost the mirror opposite. Multiples are 9, 10, 11 times. There's tons of cash on the balance sheet. These are very, very healthy companies. I think we're at a very, very interesting and very opportunistic inflection point on the technology side.
Microsoft's topping the headlines today. The software giant planning to raise $3.75 billion in its first bond offering. Microsoft is splitting the offering between 5-year notes and 10-year debt, also some 30-year bonds. The company hopes to take advantage of its top credit rating and what it thinks is an undervalued share price to fund a share buyback program and invest in technology. We're back with Robert Hagstrom, portfolio manager with Legg. He's joining us from Philadelphia. Robert, do you think that Microsoft shares are undervalued?
They are, in the interest of fair disclosure, it's our #1 holding in the growth trust portfolio. First time we've owned Microsoft probably since 2001 that I can remember. The stocks are deeply, deeply undervalued, and you can simply figure that out by looking at what the stock price today is discounting, and what it's discounting is ever slow sales growth and a perpetually decline in margins, and we just don't think that's the future of Microsoft.
Well, then why are they issuing debt in order to repurchase shares? They've got cash. Why don't they use some of that?
Well, I think it's very interesting. First of all, they'll be issuing debt below the cost of capital, so they're going to get a positive spread on this debt, and you would want, if you're going to be issuing debt, you'd want to be doing it in a low interest rate environment here. So to lock up long-term 10-year, 5-year, 10-year, even 30-year paper at these rates is a very smart thing to do. It also gives them additional flexibility. I noticed today Yahoo was up. In the interest of fair disclosure, we own Yahoo in the portfolio. As you know, the conversations between Microsoft and Yahoo have reheated up. And there may be some type of deal in the off-works, and this could give them additional flexibility. I also think it's smart that Microsoft is buying back stock because it's buying an undervalued asset, and that's a smart thing to do with your capital.
Is your call on Microsoft based on its business model? I mean, have they been able to take advantage of changes in software technology, such as software as a service? What innovations do you count on for Microsoft rather than just the annuity business?
Well, clearly they're at a juxtaposition in the marketplace where they're going to have to shift from the desktop, $119 to buy some Microsoft software to something that's maybe less expensive over the Internet. But we think that Microsoft can compete here. I would also point out that I think they are committed to being a participant in the Internet. They're behind the curve on the Internet. That's the reason why I think they're in negotiations with Yahoo, that they know that the future is their ability to compete at the Internet level. I think they will be successful there. And then lastly, I think a guest said earlier in the program about Windows 7. We're very optimistic about Windows 7. It's a good product. I think it'll be very healthy for them. So I think Microsoft understands they're under the gun. I think they understand that they're in a situation that demands that they take proaction here. We believe they're doing so, and we believe the stock price just discounts something that is not going to ultimately occur at Microsoft.
Robert, you like some other global technology names, whether it be Cisco or Nokia. Let's start with mobile phone technology. Why do you like Nokia, a hardware maker?
Well, I mean, we're huge bulls on cellular telephone, globally speaking. Pim, if you think about the next 1 billion people that are going to access the Internet, they'll do it with a cell phone. More and more of us are accessing the Internet via cell phones. Nokia, world's largest, #1 in China, #1 in India. They own the commodity side of the market there. Because of their scale, they are the low-cost provider there. They're like the Dell of handset makers. They have more work to do on the smartphones, but here, 4 out of 10 of the smartphones sold worldwide are Nokia smartphones. So they're doing a good job on the smartphone side as well. We're just very bullish in the entire cell phone market, whether it be handset, software, or chips.
You don't think that it's a margin-crushing business? You don't think that it's all going to be commoditized? I mean, couldn't we be saying the same thing about Motorola 5 years ago?
Absolutely. It is a margin-tough business, particularly on the low end. But, I would point out Walmart and Dell do a pretty good job on low-margin business. It's a question of efficiency, being the low-cost provider, and scale is the key here. If you're a scale player, which Nokia is, you can underprice your products relative to competitors and still make a few nickels on the other end.
What about Cisco? They've been on the acquisition trail, no secrets there.
Yeah.
What about Cisco's strategy? They want to be both the pipe. They also want to be at both ends of the pipe.
Yeah. I think Cisco's just a phenomenal company. I think when you think about the Internet backbone, Internet infrastructure, it's something that's going to continually grow for many, many, many years, and Cisco's a dominant player. It's interesting. I saw a stat today, Pim. YouTube, the daily usage of YouTube today carries more Internet traffic than the entire Internet did in the year 2000. Internet today is 75 times bigger than it was in the year 2000. If you think about where broadband's going, usage is going, the number of users that will be accessing the Internet 5, 10, 15 years from now, it's hard not to be a bull on Cisco.
Then if you're going to use YouTube as an example, though, Robert, let me put it to you, YouTube still doesn't make any money.
Well, we have to monetize. We have to figure ways to monetize that. But, as I've always learned this with Yahoo, too, the biggest issue is trying to get the eyeballs. You want to learn how to monetize eyeballs, but the hardest thing is to get the eyeballs. What's so great about YouTube is they've got the eyeballs. Now we have to figure out how to monetize those eyeballs. But make no mistake, you want to have eyeballs. YouTube has eyeballs. Yahoo has eyeballs. They'll do very well.
What about Google? You mentioned YouTube. Are you a buyer of Google?
Yeah, we own Google, and we've owned it actually since the IPO. I think our average price on the stock is about $90. So we've been a long-term bull in Google. We like Google very much. We like it a little bit cheaper than where it is now, but we think it will be a dominant player on search, on entertainment on a global basis. Google, it's hard not to be a liker of Google stock on a long-term basis, but we're always trying to get it at cheaper prices.
Robert, how do you respond to people that say this is the author of the Warren Buffett way, and there he is buying technology stocks? How do you explain that contradiction?
Well, the challenge, I think, is to try to overlay the Warren Buffett way into picking technology stocks and trying to think about technology as business and trying to do business valuation of technology stocks. It is a challenge. These are not soda pops and razor blades. The business models change. It's a very disruptive type industry. It's a global industry. But if you get it right, the returns here in technology are going to be extraordinary. So we want to be sensible. We want to be valuation sensitive. We apply the Buffett methodology to valuing businesses, and it's worked out very well for us.
All right. I want to thank you very much, Robert Hagstrom, portfolio manager with Legg Mason Value Trust, coming in and giving his thoughts about technology.